This is the capital plot. If I handed you $1 million today and told you to buy a property in Dubai, there is a massive chance you'd pick the wrong area. And look, I get it. Everything in this city looks like a gold mine from the outside. But fast forward 2 or 3 years from now, and you could easily be sitting on a generic apartment that is doing absolutely nothing. Meanwhile, the guy who bought just a few postcodes down the road, he's sitting on a massive 25% equity gain. According to the latest data from DXB Interact, Dubai's property market clocked over 36,000 transactions in the first 10 weeks of 2026 alone. The market is moving incredibly fast, but so is the danger. To stop you from making a life-altering mistake, I am ranking every major area in Dubai from absolute best to worst, based on the latest 2026 market shifts. We're dividing them into 3 distinct buckets: income, capital growth, and wealth preservation. But first, we have to start with what I call the danger list. Because if you get this wrong, nothing else in this video is going to save your wallet. The single biggest trap on the YouTube timeline right now is people telling you, hey, this area is super popular, so it must be a great investment. Or worse, they show you an attractive rental yield on paper and promise it'll last forever. It won't. Right now, we are dealing with a massive narrative in the market. Reports from major research houses point to a colossal delivery pipeline of new housing units coming online by the end of 2026. We call these saturation zones. These are areas where thousands of nearly identical studios and standard one-bedroom apartments are hitting the market at the exact same time. We see this friction building heavily in mid-market corridors like Jumeirah Village Circle, JVC, and specific high-density pockets of Business Bay. Let me be completely honest. JVC and Business Bay are not bad neighborhoods. They are vibrant, central, and great places to live. The problem isn't the lifestyle. The problem is the supply. When you own a standard, run-of-the-mill one-bed in a heavily supplied postcode, you are competing against hundreds of identical listings. If your tenant wants a discount and you say no, they will literally pack their bags and move to the exact same layout 2 floors down or in the next building over. ValuStrat's recent 2026 data shows that while prime luxury is flying, average off-plan apartment stock is facing intense competition. If you buy an average unit in a high-density area, you lose all your pricing power. Your capital growth goes completely sideways. Pro tip rule for 2026. If you can't explain exactly why a tenant would pay a premium for your specific unit over 10 others on the same street, do not touch the deal. Now let's talk about the upside. There is no single best area in Dubai. There is only the best area for your specific financial goal. If your goal is steady, monthly passive income to replace your 9-to-5 or fund your lifestyle, you need to think like a business operator, not a tourist. The biggest mistake buyers make here is purchasing a shiny apartment in a glamorous tourist district, overpaying for it, and watching their net returns get completely eaten alive by high maintenance and service charges. Real cash flow optimization happens in high-utility, practical areas like Al Farjan, Discovery Gardens, Warsan, and the Dubailand Residence Complex. People don't rent here because it's glamorous. They rent here because it's highly functional, affordable, and close to major highways. Because your entry price per square foot is significantly lower, your rental yields are incredibly healthy. In fact, data shows these affordable communities are seeing massive rental absorption because rising rents closer to the city center are forcing everyday professionals to move inward. When you structure these deals correctly, you can easily pull clean net returns in the 7% to 8% range. Your win here isn't a flashy headline, it's boring, predictable cash flow. But let's say you don't care about monthly income right now. You want to double your equity. You want capital velocity. This is where bucket number 2 comes in: capital appreciation. The golden rule of growth? You cannot buy a fully developed, 100% completed neighborhood and expect explosive gains. The cake is already baked. You have to find areas driven by confirmed infrastructure catalysts before the general public catches on. For 2026, we are heavily tracking 3 major zones: Dubai South, Jumeirah Garden City, and Dubai Creek Harbor. As Faisal Durrani, partner at Knight Frank, frequently highlights in his Middle East research, value in Dubai is created when infrastructure arrives before the supply fully matures. But fair warning, buying in a growth corridor requires stomach. You are going to have to live with construction noise, dust, and delayed timelines for a few years. If the infrastructure catalyst isn't fully funded and legally backed by the master developer, you aren't investing. You are gambling. Finally, we have the sovereign vaults. This is where you park your money if your number one priority is protecting large amounts of capital over generations. Every year, international buyers flock to ultra-luxury areas like Palm Jumeirah, downtown Dubai, and Dubai Hills Estate, expecting aggressive, speculative short-term price doubles, and then they feel disappointed. These premium areas behave exactly like prime districts in London, New York, or Paris. They are driven by one factor: absolute, unreplicable scarcity. There is only one downtown Dubai. There is only one Palm Jumeirah. According to Knight Frank's latest 2026 price forecasts, premium family villas and prime lifestyle communities are massively outperforming the wider market, showing steady annual value growth of 8% to 12% because affluent end users are snapping up ready homes. The trade-off here is your yield. Because entry prices are sky high, your net rental returns will be lower, usually compressing down to around 4% or 5%. You don't buy a blue-chip property on the Palm to hit aggressive yield targets. You buy it for bulletproof liquidity and global asset preservation. At the end of the day, building a real estate portfolio that actually gives you financial freedom isn't about buying 3 properties at random because a slick broker told you to. It's about aligning your capital directly with your exact risk profile, your timeline, and your goals. Subscribe to The Capital Plot